This is the second in a three-part series of resources on adjusting entries. Part 1 describes the reason we need adjusting entries. We then consider unrecorded transactions, both receivables and liabilities. Part 2 investigates prepaid expenses. Part 3 inspects unearned revenues. In the previous resource, we realized that circumstances change in the business world. Sometimes we miss things that have economic effects on our company, and we must make some adjusting entry at the end of the month. Our general process in creating these adjusting entries is rather straightforward. First, we need to identify the accounts affected. One account will always be a balance sheet account. This will get matched by changes to one or more income statement accounts. Then we need to perform appropriate calculations to find the dollar amount of the transaction. We look specifically at unrecorded liabilities and receivables. Another form of adjusting entry is a prepaid expense. Sometimes it makes sense for a company to pay for a large, recurring expense up front. Or maybe the terms of the expense require that we pay twice a year or quarterly. For example, consider things like rent, insurance, or even office supplies. If you can afford it, it is reasonable to pay for months of rent at a time. The terms of an insurance policy may be such that it only need be paid every so often. And the company may get a discount if they buy large amounts of office supplies at once. For any of these prepaid expenses, the items purchased become an asset to the company that gets used up over time. How do we account for these purchases and expenses? Unlike the unrecorded liabilities and receivables, prepaid expenses require multiple journal entries, one for the initial purchase, then the adjusting entry at the end of each month as the asset is consumed. Let's see some examples. We look at our intrepid stuffed animal seller, Polly's Plushies. As part of their growing business, they realized they needed additional insurance, and so purchased a 6-month policy for $1,200 on November 1st. The main reason they got the additional insurance policy was because they expanded into direct sales to customers. On November 1st, Polly's Plushies leased a kiosk at a local shopping mall, paying 4 months worth of rent up front for $9,000. How do we enter the original transactions into the general journal? What adjusting entries are needed at the end of November? The initial journal entries for November 1st are actually straightforward. Both were cash transactions, paid in full. But what exactly was paid for? Both the insurance policy and the prepaid rent are assets to the company. They each create new asset accounts, prepaid insurance and prepaid rent. Both the prepaid accounts increase, and assets increase with debit amounts. The asset cash is decreasing, and assets decrease with credit entries. So the first journal entry provides the date of the transaction, a debit of $1,200 to prepaid insurance, a matching credit to cash, and a description of the terms of the insurance policy. The other journal entry provides the date of the transaction, a debit of $9,000 to prepaid rent, a matching credit to cash, and the description explains that the rent is paid for a period of 4 months. But how do we create the adjusting entries at the end of November? First, let's consider the insurance policy. We are using up an asset, so that account will be credited. This will be matched by an increase and an expense, in particular, the insurance expense account. Since the expense increases, this part of the entry will be entered as a debit. The question remains, what is the dollar amount of this entry? Since 1 month has passed since Polly's Plushies took out a 6-month policy, the value of the asset will decrease by 1/6. We multiply the $1,200 value of the policy by 1/6, and the entry will be in the amount of $200. The journal entry starts, as always, with the date. Then we see the debited account, insurance expense, and the amount of the debit, $200. Then we have the credited account, prepaid insurance, with the matching amount. The entry closes by describing the transaction to account for the insurance expense accrued during November, with the calculation required to find the amount of the transaction. But what about the prepaid rent? The analysis is almost identical to that for the prepaid insurance. We are using up the asset prepaid rent, so that account will be credited. That amount is matched to rent expense, which increases with a debit amount. But how much is the transaction? Since Polly paid for 4 months' rent, we have used up 1/4 of the purchase amount. So we have 1/4 of $9,000, which is $2,250. The entry starts with the date. Rent expense is debited for $2,250 and is matched by a credit to prepaid rent. This entry accounts for the rent expense for the month of November and was calculated as 1/4 of $9,000. But what happens if the customer prepays? That is, how do we account for unearned revenues? Stay tuned for the next resource.